Today, a significant development emerged in global financial markets that demands immediate attention from investors and institutional observers worldwide. Major banking institutions have initiated unprecedented physical silver acquisition programs at price levels exceeding $72 per ounce, marking a dramatic reversal from their historical trading patterns and raising serious questions about the structural integrity of the COMEX precious metals exchange system. This morning's analysis reveals that three of America's largest financial institutions have executed substantial silver purchases totaling over 47 million ounces within a 6-week period, paying premium prices that represent a complete departure from their previous market positioning strategies. The timing and scale of these acquisitions coincide with mounting evidence of severe supply constraints within the global silver market infrastructure, particularly affecting the commodity exchange mechanisms that have governed precious metals pricing for over 5 decades. The implications extend far beyond typical commodity market fluctuations. These banking institutions, which historically maintained short positions in silver futures markets while accumulating physical metal at suppressed prices, have fundamentally altered their approach in response to what appears to be an emerging supply crisis within the exchange delivery system itself. To understand the significance of this development, we must examine the historical context of precious metals markets and the role of major financial institutions within this framework. Since the establishment of modern commodity futures trading in the 1970s, large banks have operated as market makers in precious metals, facilitating price discovery through paper contract trading while maintaining relatively modest physical inventories. The COMEX division of the Chicago Mercantile Exchange has served as the primary price discovery mechanism for silver in North American markets, operating on a fractional reserve basis similar to traditional banking systems. Under this structure, the exchange issues futures contracts representing far more metal than physically exists in registered warehouses, operating under the assumption that the majority of contracts will settle financially rather than through physical delivery. This system functioned effectively during periods of stable industrial demand and consistent mine production. However, the fundamental dynamics underlying silver markets have shifted dramatically over the past 24 months due to several converging factors that are now manifesting in acute supply pressure. The current crisis stems from 3 primary developments that have fundamentally altered global silver market dynamics. First, industrial demand has accelerated beyond historical precedent due to expanding solar panel manufacturing and electric vehicle production requirements. Silver's unique electrical conductivity properties make it irreplaceable in these applications, creating structural demand that cannot be easily substituted or reduced through price sensitivity. Second, mine production has failed to keep pace with this industrial acceleration. Global silver extraction reached a plateau in recent years as easily accessible ore deposits have been depleted and new mining projects face increasingly complex geological and regulatory challenges. The Silver Institute's latest production data indicates that new mine development timelines now extend 7 to 10 years from initial exploration to commercial production, making supply response mechanisms inadequate for addressing current demand pressures. Third, and most critically for current market conditions, sovereign wealth funds and central banking institutions have begun treating silver as a monetary asset rather than purely an industrial commodity. This shift represents a fundamental change in demand patterns, as monetary buyers typically acquire and hold physical metal indefinitely, removing it from circulating supply pools. The mathematical reality facing COMEX operations has become increasingly apparent through analysis of registered inventory data and outstanding contract obligations. Registered silver inventory represents metal that is available for delivery against futures contracts, distinct from eligible inventory which meets quality standards but remains unavailable for immediate delivery. Current registered inventory levels have declined to approximately 34 million ounces, down from over 100 million ounces, maintained as recently as January 2021. This represents a 69% reduction in available metal over a 4-year period, occurring simultaneously with expanding industrial applications and emerging monetary demand from institutional buyers. The delivery obligation structure creates additional complexity for exchange operations. February 2026 contracts currently show 67,000 open positions, representing 335 million ounces of notional silver demand. Even assuming historical delivery rates of 3%, this would require over 10 million ounces of physical metal from registered inventories that currently contain only 34 million ounces total. However, recent delivery patterns suggest that historical assumptions may no longer apply. Industrial users facing supply chain uncertainties are increasingly standing for delivery rather than rolling contracts forward, while monetary buyers have no incentive to accept cash settlements when their objective is physical metal accumulation. The banking institutions now executing large-scale physical acquisitions appear to have recognized these mathematical constraints and are positioning themselves ahead of potential delivery failures. Their willingness to pay $72 per ounce for immediate delivery compared to $28 for paper contracts just 8 months ago indicates extreme urgency in securing physical metal ahead of contract settlement dates. This pricing disparity reveals the emergence of a two-tier silver market, with physical metal commanding substantial premiums over paper contracts. Such divergence typically signals the breakdown of arbitrage mechanisms that normally keep futures prices aligned with spot market values. The London Bullion Market Association's recent vault reports confirm that this phenomenon extends beyond North American markets. LBMA-monitored silver holdings declined by 127 million ounces during the fourth quarter alone, representing the largest quarterly outflow in the organization's documented history. These outflows appear to be driven by Asian refiners and Middle Eastern institutions withdrawing metal from London storage facilities, effectively severing the traditional arbitrage linkages between London and New York markets that previously provided liquidity buffers for COMEX operations. The Federal Reserve's monetary policy stance adds another dimension to current market dynamics. Extended periods of near-zero interest rates and quantitative easing programs have created conditions favorable to hard asset accumulation, while rising inflation concerns have prompted institutional investors to seek alternatives to traditional bond portfolios. Silver's dual nature as both an industrial commodity and a potential monetary hedge positions it uniquely within current macroeconomic conditions. Unlike gold, which serves primarily as a store of value, silver faces genuine supply constraints due to industrial consumption that permanently removes metal from available stocks. The banking sector's apparent pivot toward physical silver accumulation may reflect internal assessments of systemic risks within the current monetary framework. Major financial institutions possess sophisticated risk management capabilities and access to Federal Reserve data that provides early indicators of potential currency instability or inflationary pressures. Their collective decision to acquire substantial physical silver positions at premium prices suggests institutional recognition of scenarios where precious metals may serve as portfolio hedges against monetary system volatility. This institutional buying pressure compounds existing supply constraints and creates additional upward pressure on prices. Current market conditions indicate that the COMEX silver market is approaching a critical inflection point where traditional paper-based price discovery mechanisms may prove inadequate for managing physical delivery obligations. The next 97 days will likely determine whether the exchange system can adapt to new demand patterns or whether alternative price discovery mechanisms will emerge to replace futures-based trading. The implications for investors, industrial users, and monetary policy extend well beyond precious metals markets themselves, as silver market dysfunction could signal broader challenges within commodity futures systems that underpin global trade and financial stability. The convergence of these factors has created what financial analysts are now describing as a potential cascade scenario where multiple market mechanisms could experience simultaneous stress over the coming months. The interconnected nature of modern financial systems means that disruption in one commodity market can rapidly transmit through related sectors, particularly when that commodity serves dual functions as both an industrial input and a potential monetary asset. Central bank policies across major economies have inadvertently contributed to these developing tensions. The Federal Reserve's prolonged accommodation period, combined with similar policies from the European Central Bank and Bank of Japan, has created unprecedented global liquidity conditions that have driven institutional investors toward alternative assets. This monetary environment has fundamentally altered traditional investment allocation patterns, with sovereign wealth funds and pension systems increasingly seeking assets that can preserve purchasing power during periods of currency debasement. The timing of these silver acquisitions coincides with broader shifts in international monetary arrangements that suggest institutional awareness of potential system-wide adjustments. Recent bilateral trade agreements between major economies have increasingly incorporated provisions for non-dollar settlement mechanisms, while central bank gold purchases have reached levels not seen since the immediate aftermath of the 2008 financial crisis. These developments occur against a backdrop of mounting fiscal pressures within developed economies. United States federal debt has expanded beyond $33 trillion, while interest payments on this debt are approaching levels that could constrain future monetary policy flexibility. European nations face similar fiscal challenges, compounded by energy security concerns that have emerged following recent geopolitical developments. The industrial demand component driving current silver market dynamics extends beyond immediate manufacturing requirements. Solar panel production capacity has expanded dramatically as governments worldwide implement renewable energy mandates designed to address climate policy objectives. The International Energy Agency projects that solar installation rates must triple over the next decade to meet stated carbon reduction targets, creating structural silver demand that far exceeds current production capabilities. Electric vehicle manufacturing presents additional demand pressures that compound solar sector requirements. Each electric vehicle contains approximately 1 ounce of silver in various electrical components, with production volumes projected to reach 40 million units annually by 2030. This represents 40 million ounces of annual industrial consumption from automotive applications alone, equivalent to nearly 5% of current global mine production. The semiconductor industry adds another layer of structural demand, as advanced chip manufacturing processes require increasing quantities of silver for electrical connections and heat dissipation. Artificial intelligence and data center expansion have accelerated semiconductor production requirements, while reshoring initiatives aimed at reducing supply chain dependencies have prompted domestic manufacturing capacity expansion that further increases silver consumption. These industrial applications create what economists term inelastic demand, where consumption patterns remain relatively stable despite price fluctuations. Unlike speculative investment demand, which can reverse rapidly based on market sentiment, industrial consumption continues at levels determined by production schedules and long-term contracts that cannot be easily modified. The supply-response mechanisms that historically balanced commodity markets have proven inadequate for addressing current silver market conditions. Primary silver mines, which extract silver as the principal product, represent only approximately 30% of global production. The majority of silver supply comes as a byproduct of copper, lead, and zinc mining operations, where production decisions are based primarily on base metal economics rather than silver prices. This production structure creates significant delays in supply response to price signals. Even substantial silver price increases may not incentivize additional production if base metal prices remain stable or decline. Current copper market conditions, influenced by Chinese economic uncertainty and global manufacturing slowdowns, have actually reduced some silver byproduct production despite rising silver prices. New mine development faces increasingly complex challenges that extend traditional project timelines. Environmental permitting processes now require 5 to 7 years in developed jurisdictions, while community engagement and indigenous rights considerations add additional regulatory requirements. Capital costs for new mining projects have escalated substantially due to inflation in equipment and labor markets, requiring higher long-term price assumptions to justify investment commitments. The geographical concentration of silver production creates additional supply vulnerabilities. Mexico accounts for approximately 23% of global production, Peru contributes 18%, and China produces 15%. Political developments or policy changes in these jurisdictions could significantly impact global supply availability, particularly given the strategic importance governments are increasingly placing on critical mineral resources. Recent mining nationalism trends have emerged across several producing nations, with governments implementing higher royalty rates and export restrictions designed to capture greater value from natural resource extraction. These policies, while potentially beneficial for producing countries, create additional uncertainty for industrial users dependent on reliable supply chains. The financial infrastructure supporting commodity markets has evolved significantly since the last major precious metals disruption in the early 1980s. Derivative markets now represent orders of magnitude more trading volume than underlying physical markets, creating complex interconnections between financial institutions that extend far beyond traditional commodity trading relationships. Modern banking institutions maintain extensive derivative positions across multiple commodity markets, with silver exposure often embedded within broader precious metals trading books that include gold, platinum, and palladium positions. Credit exposure calculations must account for correlation risks between these markets, particularly during stress periods when traditional diversification assumptions may prove inadequate. The regulatory framework governing commodity markets has not kept pace with the complexity of modern trading structures. Position limits designed to prevent market manipulation were established when markets operated primarily through physical delivery mechanisms, but may be insufficient to address concentrated financial institution exposure in today's paper-dominated trading environment. Clearing and settlement systems that process commodity trades face operational challenges when delivery requests exceed normal parameters. COMEX clearing members maintain capital requirements based on historical risk models that may not adequately account for simultaneous stress across multiple commodity markets or unprecedented delivery demand from institutional buyers. The international monetary system implications of precious metals market stress extend beyond immediate commodity considerations. Silver has historically served as a monetary metal alongside gold, and its potential remonetization by central banks could signal broader questions about the sustainability of current fiat currency arrangements. Recent statements from Federal Reserve officials have acknowledged growing challenges in maintaining price stability while supporting economic growth through monetary accommodation. The traditional Phillips curve relationship between unemployment and inflation has broken down, making monetary policy decisions increasingly difficult as economic data provides conflicting signals about underlying economic conditions. Global debt levels have reached unprecedented proportions relative to economic output, with total debt to GDP ratios exceeding levels seen during previous crisis periods. This debt burden limits the fiscal policy tools available to governments during economic downturns, potentially forcing greater reliance on monetary policy interventions that could further undermine currency stability. The emergence of central bank digital currencies represents an additional factor that could influence precious metals demand patterns. As governments explore digital alternatives to physical currency, public awareness of monetary system evolution may drive increased interest in alternative stores of value that exist outside government control mechanisms. Geopolitical tensions have added another dimension to commodity market dynamics that extends beyond traditional supply and demand fundamentals. Trade policy uncertainty, sanctions regimes, and strategic resource competition between major powers have created additional premiums for supply security that influence institutional purchasing decisions. The current situation represents a convergence of multiple structural trends that have been developing over several years, but are now manifesting simultaneously in observable market stress. The banking sector's response suggests institutional recognition that traditional market mechanisms may prove inadequate for managing these converging pressures, prompting preemptive positioning ahead of potential system-wide adjustments. Understanding these interconnected dynamics becomes essential for assessing the broader implications of current precious metals market developments and their potential impact on financial stability, investment strategies, and economic policy decisions in the months ahead. The strategic positioning currently unfolding within precious metals markets reflects broader institutional concerns about monetary system stability that extend well beyond immediate commodity considerations. Financial institutions are demonstrating through their actions a level of urgency that suggests internal risk assessments have identified scenarios where traditional portfolio hedging mechanisms may prove inadequate during periods of systemic stress. The Federal Reserve's current policy framework faces unprecedented challenges as inflation expectations become increasingly difficult to anchor through conventional monetary tools. Recent economic data indicates persistent price pressures across multiple sectors despite aggressive interest rate adjustments over the past 18 months. Core inflation measures continue registering above target levels, while employment markets show signs of structural shifts that complicate traditional policy calibration methods. Chairman Powell's recent statements to Congress acknowledged growing complexity in monetary policy transmission mechanisms, noting that standard models for predicting policy impacts have shown reduced reliability during current economic conditions. This admission carries significant implications for financial institutions attempting to position portfolios for various economic scenarios over the coming quarters. The banking sector's apparent pivot toward physical asset accumulation coincides with mounting concerns about commercial real estate exposure and regional bank stability. Federal Deposit Insurance Corporation data reveals increasing loan loss provisions across multiple banking segments, while unrealized securities losses on bank balance sheets have reached levels not observed since the immediate aftermath of the 2008 financial crisis. These banking sector vulnerabilities create additional complexity for monetary policy implementation, as traditional credit transmission channels may not function effectively if financial institutions face capital constraints or liquidity pressures. The Federal Reserve's recent bank stress test scenarios have incorporated more severe economic downturns than previous years, suggesting regulatory awareness of potential system-wide challenges. International monetary developments add another layer of complexity to current market dynamics. The European Central Bank faces similar challenges with persistent inflation alongside economic growth concerns. While the Bank of Japan has begun modifying its yield curve control policies in response to currency pressure and inflation developments that represent significant departures from historical patterns. Today, a significant development emerged in global financial markets that demands immediate attention from investors and institutional observers worldwide. Major banking institutions have initiated unprecedented physical silver acquisition programs at price levels exceeding $72 per ounce, marking a dramatic reversal from their historical trading patterns